In a 2019 study, Chaos in Retirement Income, done by James B. Sandage, we find that when you're in the accumulation phase of retirement planning, if you can find investments with higher average returns and lower fees, you will build more wealth over time. Now, the question that we're asking here is, do higher average returns when you're in the distribution or income phase of retirement planning, does that guarantee you more success? Hello, Kurt Jackson, KJ Financial. You know, we found a majority of Americans aren't aware of this information, this type of information, and they're not getting it from their more traditional financial professionals. So we're going to continue our journey in finding out what works in the accumulation phase may not work in the distribution or income phase of retirement. So here, Sandage looks at the period from 2000 through 2016. He's assuming a $1 million investment, 5% initial withdrawals, so 50 grand a year to start, and adjusting that income up 3% for inflation each year. So the red bars, that's assuming money is invested 100% in stocks, not paying any fees, and earned an average return of 6.1% annually. Yet, it was totally out of money in 17 years in 2016. Now, granted, this was a very challenging period with the dot-com crash from 2000 to 2002, followed by the Great Recession from October of 2007 through March of 2009, which, if we're being honest about evaluating our retirement strategies, isn't this exactly the type of period we'd want to make sure our retirement income strategies would be effective? Okay, now let's look at the blue line. The blue line is 100% fixed income, half in T-bills, half in long-term treasuries, paying 1.5% annual fee, earning an average annual return of 4.8%. So in an accumulation situation, there is zero chance the blue line would do better than the red blocks. But in a distribution or income situation in retirement, at the end of 2016, where we were out of money in the market, there's still $427,933 remaining in the account. So when you're planning for the income or for the distribution or the income phase of retirement, utilizing strategies that worked okay for accumulating or building wealth while you were working will likely leave you in retirement having to cut back your lifestyle and maybe still even outliving your money. And look, this is pretty much universal. That's two things nobody wants to have happen to them in retirement. So once again, your takeaway from this should be you absolutely can't use the same strategies you were using in the accumulation stage for the distribution or income stage of retirement. So isn't it time for you to get your free retirement success score to see where you are, and then also to see how our volatility buffer strategies can help you combat the uncertainty of the market? If you're ready to get that retirement success score, go to www.bookkurtnow.com, find the 30-minute discovery call option, then go on and click on it and find a time on my calendar where you're available for us to have a conversation for about 30 minutes. Right, have a great day, and thanks for tuning in.